What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 16th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to talk about what I genuinely feel is the greatest threat to cryptocurrencies here, not only in the near term, but over the next coming years. And it may surprise you that even though we've talked a lot about the FTX debacle and the continued contagion from that situation, while I do believe that that is going to be a net negative and a way down on the crypto industry, it is not the greatest threat. It is the macro perspective. What's going on in equities, the bond market, housing, in the real physical economy with corporate earnings, with the waves of inflation that we've had to deal with, and how that is going to impact the future of cryptocurrencies. I'm going to be talking about a lot of things that most of the crypto channels simply don't talk about. So if you like to get big picture, if you want to dive into the things that really impact what kicks off the next bull market, then let's go ahead and dive into the video. Drop a like if you enjoy the rambling, and let's go ahead and start. So, as you all know, back during August, if you watch the channel religiously, we talked a lot about how we took advantage of that relief rally, selling a lot of our positions here in August around that 24, 25K price range. And we not only did so because we likely saw that there was going to be continued fallout from Celsius. We hadn't reached the typical bear market top to bottom decline of over 80%, which at a minimum we should expect with how much damage has been done just within the crypto space alone. But on top of that, we have to consider that crypto has never lived through one of these macro bear markets in equities and the housing market. We have never seen Bitcoin live through a proper 50% plus decline in equities. And with Bitcoin bear markets usually being anywhere from around 80 to 85% over the last few cycles, what is it going to look like when we start to step into one of these situations where inflation, likes which we haven't seen in over 50 years, is persisting through the economy, and the Fed has not been able to get a full grip on just yet? So that's what we're going to be talking about today. And again, we're going to dive into a lot of price action to start here, because while we can talk about the CPI readings and some of those data metrics, I want to go ahead and just try to pull from history and see if we can see some interesting correlations across the indices, interesting correlations with the macro metrics to see if we could be repeating history to some degree. Now, I know a lot of people, especially us here on the channel, we talk a lot about the NASDAQ. And a lot of people are very excited as of recent because the NASDAQ, after setting in new bear market lows on October 13th, a little over a month later, has now finally gotten above its 200-week moving average. A lot of people are starting to claim that this might be a temporary deviation. The bottom is in. The Fed expectations of rate hikes are going to be declining because the CPI reading was a positive upset and showcasing that the Fed has got a tightening control on inflation. And yet again, the bulls have come out of their position under a rock and have now stated, look, equities are rallying, it's time to buy the dip, just like they've done every step of the way. And trust me, guys, I'm generally a more optimistic person. I'm a pragmatic optimist. I do believe the number goes up and to the right as history progresses. But it doesn't mean that it's happening here today, and it doesn't mean that this rally that we've seen so far is something that can be sustained into an entire bull market. We'll talk about that, okay? So we are still well below the 200-day moving average, which is generally our bull market indicator here. Price should be generally spending the majority of its time about the 200-day moving average if we are entering into a bull market. So we don't want to rush into things just yet on that principle alone. But I want to go ahead and talk a little bit about the Dow Jones here, because while the NASDAQ has been showing some weakness, a lot of people are really excited about how the Dow Jones has been performing. On, for example, the 200-week moving average, right? We saw that it deviated temporarily back in October and got above there. And not only that, it's above its 200-day moving average and really not too far away from the previous all-time highs. I'd say probably about, if we were to kind of just go ahead and mark it here on the chart, from where we are now, probably around a 10% mark, right? So really not that bad, right? A lot of people are saying, hey, what recession, Nick? What pullback in the market are you talking about? Dow Jones just rallied back up just 10% below its previous highs. It's important to understand here where you're exposed. If you're exposed to Dow Jones, to the NASDAQ, most of us here on the channel, most investors out there, especially retail investors, are exposed to the highest growing assets, crypto and technology stocks, i.e. the NASDAQ. So that's important to understand first. But I want to talk about why, while this looks good, it does not mean that we're starting the next bull market. And we need not look further than back during the end of the dot-com bubble. Now, the Dow Jones, just like over the past decade, during the 90s went through a soaring period of ascension and valuation. We can go ahead and just use the percentage date range tool here. We can even take it back here to the 80s, right? Roughly speaking, around a 13-year period where the Dow Jones went up 569%. Pretty impressive considering that the NASDAQ and all these other indices did even more during that period of time, as we went through an expansive wave of technology and innovation that really started to catapult valuations in publicly traded companies as consolidation and, again, conglomerations of companies started to become more popularized. And then here during the 2000s, right, during the dot-com bubble, which we will see later on, was much more harsh to the more high-growing market leaders, i.e. the tech stocks, the dot-com bubble. We can see that the Dow Jones had a much more moderate correction. But in general, from top to bottom, it went down about 38%. Right? The important thing I want to focus here is that whether or not you see anything familiar about this. I want to just go ahead. I'm going to turn off the drawings here. I'm going to keep the indicators on the screen, right? And I want you guys to look at this chart and let me know if you spot any interesting trends. There could be a ton of different things, and I'll point out a couple of them in a moment, but I just want to give you some time. Do a little thought experiment. Just take a look at the chart here, right? We've got our 200-week moving average here and our 200-day moving averages here. I'll go ahead and make this a different color here so you guys can see this a little bit better, right? Okay. Just take a look at the chart. There's a few things I notice here that I think are very important and can serve as a really good guide stone for us going forward when it comes to relief rallies in this market and deciphering whether or not it's really time to go long. Take a look here at this chart. There were multiple times where the Dow Jones crossed below the 200-day moving average and got above there, deviating time and time again. And what did it do practically every single time it did that? And once it deviated below that 200-day moving average, it rolled down to new lows. We got above the 200-day moving average, we rolled down to new lows. And again, and again, and again, and finally got to the point where after some time, years later, practically 3 years after the peak of the dot-com bubble, long period of time, finally did we set on our bottom and start to trend higher once again. So 2 things that stand out to me is that when we get a proper recession, it's usually going to take 1.5 to 3 years, which again is a wide time range. It can vary depending on each cycle. No one is exactly the same. But we see repeated patterns here where the Dow Jones, which didn't expand as much as the NASDAQ per se during the dot-com bubble, which again, just for perspective, during that same period of time, right? If we measure from top to bottom, from that low in 1987, went up 1,600%, right? Very, very big difference in performance. And it's likely that these defensive stocks are going to fare much better during these periods of time. Now, let's just go ahead, right? We understand on a conceptual basis, I think, the Dow Jones is made up of a lot of big, institutional companies that have really strong streams of revenue. They have really good business models. A lot of them are consumer cyclical. They're things that people need on a routine basis, whether inflation goes up or down. That's how they can handle these more risk-off periods much better. But again, take a look here at the similarities. Each and every time, new lows. Many times in which we came above that 200-day moving average. Starting to look familiar? This is not the only time we've seen this throughout history. And it's a sign of what's going on right now. The defensive stocks do perform much better. They've got stronger corporate earnings. They have much better balance sheets. Fundamentally speaking, they should be at around this range during the more optimistic waves and relief rallies during bear markets. Now let's go ahead though and take a look at the NASDAQ, and this is where it really starts to come together. Take a look at the chart where we are now. So this is throughout the close of 2021 into the highs in November of 2021. and where we are now in November of 2022, nearly a year later. We were expanded above the 200-day moving average for a long period of time without crossing. And we finally got to cross, and ever since it's been serving as resistance, and now we're teetering with the 200-week moving average. What happened during the dot-com bubble? For more than 2 years, we did not get across below that 200-day moving average. And when we started to contest it, we broke below there and struggled to hold the 200-week. Never again coming up to test that 200-week for years to come. Not until late 2001. I'm getting caught up in my time frames here. And after that, dragging lower and lower and lower until late October of 2002, where we finally set in the lows, and still for a long period of time pushed roughly sideways without making the expansive rally that later came on more than a decade later. So again, highlighting where we were there at around 2,500 points at the contestment of that 200-week, we may have a very painful, long way to go, full of capitulation, full of companies unfortunately going under, not being able to raise capital, diluting their stock too much, trying to survive, unfortunately burning too much capital, having too thin of margins, or more likely bleeding through money and having negative margins. This is the kind of stuff that goes through a proper recession. And if anyone out there is still trading off that mindset that the Fed's got to pivot, the Fed's got to come in and save the day, they've been doing it for the last decade, right? You likely got another thing coming, because the inflation objective of getting it down to that 2% target, as Jerome Powell has been very clear about since August, and rightfully so, is priority number one. The Fed cannot deal with heightened inflation. Now again, I understand some people have started to look at the metrics. They've seen oil has stayed flat since back in August. It's not expanding. It's definitely not declining anymore, but it's been sitting there since that August value. Natural gas is kind of in its mid-range here, where we were back in October of 2021, here in April of 2022, and in July of 2022. It's not at the exacerbated range. It's not too low, just generally pushing sideways. And some people are getting really excited about the dollar index starting to go down. Dollar's starting to lose a little bit of momentum from its previous cycle and is now down towards the 200-day moving average. All these things are definitely interesting, and it's the market starting to potentially price in that the Fed might be getting a much better grip on inflation. By the dollar index going down, it likely means that other central banks are going to start doing some more tightening, and that the Fed may start to slow its pace a bit. That's at least what the market is pricing in right now. That's what equities are starting to price in. But I want to go ahead and take a look at some of the external metrics and the reality that we are in right now that I think a lot of people don't want to face. You know, last month's CPI for the month of October was a quote-unquote positive upset. Got a lot of people excited. But what a lot of people don't focus on is they focus on the yearly metric, but they don't look at the month-to-month metric. And what many people don't know is that we had our highest reading month over month since back in June. We are still month by month ticking up on inflation, even with a positive upset. And if you measure the current 0.44% month over month increase that we got, and you do that on an annualized basis, you're still well and far away from that 2% target that the Fed has. It's roughly around, I think, 3.6%, give or take. I'm doing my on-the-spot math. I did a calculation on it earlier, but you get the gist. Still not at 2%, and that's a year of inflation at these levels, and that's hoping that the Fed can keep it at this base. Now, if we start to see a month or two where this metric, like back in July, stays at 0% or 0.12%, that's your sign there to get eager. That's your sign where you start saying, oh my gosh, the Fed's actually doing it. They're sticking to their the federal funds rate hikes. They're really starting to tame inflation. They've got it in the bag. The Fed's doing the right thing. They're going to put us through a painful short-term window of pain to cool down that excessive demand and spending in the economy and get us back on track to stability and trust in the currency. That's the kind of stuff that's going to start being interesting. But now we are not seeing that. We're still slowly but steadily ticking up here. So what does that tell us? Well, I think we can see it through a lot of the metrics within the housing market. Housing inventory is still declining month over month by thousands of properties. We should be seeing this number ticking up if we want to cool down housing prices. We can see that the price to rent ratio is extremely crazy. The price of properties is still well above in the second quarter of 2022, well above its historical norm against rents. And we can see through housing prices right here in the chart, while we have started to flatline throughout 2022 as mortgage demand has started to go down, prices are still holding up. So what gives? Why are inventories not shooting up like a rocket if no one's taking out mortgages? Well, it's the reason that has been driving this bubble for so long. It's not just people taking out cheap financing, but it also has to do with the simple fact that there is excess liquidity in the system through quantitative easing. And I gotta tell you guys, the silence from the Fed on this, or more specifically other market participants that are saying so much focusing on the federal funds rate, right? And how great it is that we might only go to maybe 5% on the federal funds rate versus 5.5%. And that's gonna save the stock market somehow. All these, shoestrings that people are holding on to, right? They completely ignore the balance sheet and how right now the Fed, got to give them credit where it's due, it's on autopilot. It's reducing month over month. Now, just to put this on the monthly chart so we can kind of scroll through and get the metrics, we can see that month by month the Fed is unloading tens of billions of dollars into the open markets. And that's through the form of mortgage-backed securities and U.S. Treasuries. So what's that going to mean? It's going to mean that if they're selling that amount per month in dollar value, they are unloading bonds, U.S. Treasuries, and mortgage-backed securities, right? Again, those mortgage products that people invest into. They're unloading that in the market. And that means if they're selling it, someone's buying it. Someone's got to buy it. No matter what the price is, someone is spending that money out there, right? $60 billion, $40 billion, $50 billion, it varies by month. Right? But there's a general target range the Fed has, right? And that's tens of billions of dollars every month. That is liquidity that's not going to crypto, certainly not crypto. It's liquidity that's not going to technology stocks, and not even those defensive stocks. And this is the kind of measures that start to put us in a position where even the defensive stocks, like the Dow Jones, repeat this historical pattern of not being able to sustain a long-term rally because the liquidity flows, that's the key term here, the liquidity flows are net negative now. Money is being removed out of the system. Don't let this dip in the dollar make you feel like the world is not in demand for dollars right now or some form of stability. Inflation is still crazy. While inflation might be getting a little bit better in the US, in the UK the reading was, I think, an entire percentage point higher than what people expected. Argentina, all kinds of different economies across the world, from developed to underdeveloped, are still going through the pain. And I think one thing that I think is so important to keep in mind in the US is we can be in a bit of a bubble sometimes, right? I can see the pain throughout a lot of different countries across the world as I've talked to so many people, and it's not getting better just yet. They have not been able to tame inflation because they're not doing what the Federal Reserve is doing. And the Federal Reserve also, I think, could even go a little bit harder, go 100 basis points, show that they are in the direction of taking inflation into control. And that might mean we may not have to reduce the balance sheet so much. Now, we've had this drawn here on our chart for a long period of time. We shared this with the dashboard members a little bit earlier and stuff, this big focus point on the balance sheet. But the big thing here is this. There are a couple different paths that the Fed can take. They are going to take some time. These are not set in stone, and these are just general projections. But if you want my mindset on it, where I try to be a little bit more in the middle, I don't want to be exacerbated in one direction or the other, I think it's going to be somewhere in this range from the least amount to somewhere in the middle, which would basically be reducing either half of the balance sheet expansion from here during the 2020 pandemic, or from the mid-range here, or the secondary wave of expansion that the Fed continued after that period of time. Somewhere in this ballpark, around 6.5 trillion, I think is a very reasonable range here. And if we try to just simply take a look here at the chart, if we get anything in that range, it's going to mean we're removing practically $2 trillion. $2 trillion from the base money supply. You consider the expanded credit on top of that, you're talking about trillions of dollars moved from the system. Moved away from equity value, moved away from housing value, moved away from the value of crypto assets and the most speculative investments that are available on the market. And do you really want to be exposed to assets during that period of time? Do you really want to just continuously buy the dip? Or do you want to be much more passive with your capital, have a longer term time frame horizon, get at much better prices, and not lose your shirt? I fit into the latter camp. I want to be protective of my capital because I'm not going to fight the Fed. I didn't fight the Fed for the last decade, and it paid dividends, and I'm sure as hell not going to start now and lose it all. It's very important to understand when the dynamics change, when a secular bull market is over. It is over, guys, for stocks. Just like it was here during the 90s, once we crossed through that 200-day moving average and the 200-week. And it is the exact same here during this period of time in late 2022. After a decade-long run, it's been a great time, but we're going to be making money on the way up during those good times, and we're also going to be making money on the way down, as well as planning to buy the dip for the next cycle, right? There's still a lot of great opportunities here. There's a lot of exciting, albeit sometimes scary things going on. But we got to focus right now on trying to find those value plays, doing the hard research right now when it's not very exciting and fun, making the connections, searching for those value plays for the next cycle. Who's building right now? Who's doing some exciting things that when the risk narrative comes back on, we can get really bullish on? And that's a big thing here. I know a lot of people have asked me, and I'm circulating back to crypto. Bitcoin, for example, is at its most oversold level. It's well below the 200-week moving average. This is, again, a first in its history that we've ever been suspended below the 200-week for this long, or below the RSI on the monthly time frame for this long. And again, it is likely going to continue. ETH is, in my opinion, way overvalued here. I love Ethereum. I love that it's potentially going to become deflationary. I love DeFi. Against Bitcoin, it's way overvalued here, guys. I mean, if we just simply take a look at any of the previous cycles, we can see that ETH is likely at least can come in and set a still higher low, according to history, but something at a much more sustainable level. I think there's still a very good chance we could see a 30-50% pullback, either to this range we were at before in June of 2020, around 0.05 on the ratio, or more likely down here around 0.04. I don't know when it's going to happen, but the big thing here is that we are likely to see Bitcoin, ETH, USDT, and USDC dominance spike up, and that is going to mean a big flush for the altcoin space, knocking out a lot of the false valuation and a lot of the unnecessary optimism that still remains in the altcoin space. It's going to be about searching for the players that are still active right now. Not many of them are out there building right now, but we do know of one of them here, and they're one of our long-term partners on the channel, and that is Kava Network. Now, if you guys haven't already heard about Kava, Kava is a really interesting network that combines the Cosmos SDK as well as the Ethereum virtual machine into one network. Two of the most powerful layer one ecosystems when it comes to developers, developer tools, and also the available protocols and liquidity in the space. Two of my favorites personally. And this conjoining of these networks and the functionality into one singular layer one protocol has not only allowed it to become very quickly one of the largest layer ones by total value locked, as well as new protocol deployments and users, but on top of that, they've been able to make continuous exciting progress throughout this bear market. That is my biggest green flag that gets me excited for watching Kava. I'm not saying you have to go out and buy Kava or anything like that, guys, right? But the key thing is to keep an eye on it, do your research around it, and look into it. They've got some big updates here. The big one being the launch of EVM 2.0. This is going to allow for more Ethereum-based functionality to exist on top of the Kava network that wasn't available before. Again, further tapping into the wide-reaching applications for decentralized applications in DeFi, NFTs, you name it, anything that practically could be built on Ethereum can likely now be built on the Kava network, at least over the vast majority of it. And on top of that as well, Kava Earn is launched, where they're allowing people who, again, are looking to basically earn more Kava by participating in the ecosystem rather than giving it all to venture capitalists who, again, we have seen obviously don't have the better interest in the space. They'd rather it be a network owned by the users and the developers who are building these applications. And they have some really great ways to get high yields in the form of Kava on top of stablecoin liquidity or other various tokens. So again, another great way if you're looking to get that exposure to Kava. And for those of you who just may simply want to look at owning Kava or having a safe place for it, I know right now this is a very scary time for exchanges. And again, we want to look for either, in this case, having self-custody, which I always recommend as a priority. But if you are looking to get exposure to new crypto assets or have a place that at least is a bit safer than some of the players like FTX, some of the offshore entities, you can definitely take a look at Binance US, which has now announced that it's launching Kava here. More exposure for the US market, which I think is really great. It's always a big problem is sometimes we just can't get exposure to certain assets here in the US. So big shout out to that. And last but not least as well, there's a big proposal going on for those of you who are already active Kava holders, where they're going to be proposing to remove the SWP and HARD tokens with rewards in Kava, essentially allowing for these tokens to still exist but have capped supplies and to give rewards out to participants on these protocols in the form of Kava rewards. So if you guys want to check those out, check out the link down below in the description. Follow them on Twitter through the link down below. It's definitely one of the few protocols alongside Radix, as well as some of the other ones we're watching in this channel, like Integral, that are really building in this market. They don't care if it's a bull or bear market. And to me, that's the biggest thing, because once this decline, the balance sheet is over. Once inflation is finally back down to 2% for a prolonged period of time, the Fed really has garnered control on this situation. And when valuations are very healthy levels, we will be buying. We will be going long. We will be flipping our tune when the signs are signaling that capitulation is over-exacerbated, that people are overly fearful, people are getting liquidated out of positions, which are too much risk. That is when we're going to be setting on our bids, because that is when the institutions and the smart money move in. Their priority number one, capital preservation. They've made their money. They're going to wait until the best setup comes into play to really go big and drive the next cycle. Anyways, I've rambled on a good amount, guys. If you like my rambling, even if you didn't agree with everything I said, if you liked the video, drop a like. Leave a comment down below whether you agree or disagree. I'd love to get some conversation going on, hear from you guys in the comments down below. It means a lot to me to hear from you all and just kind of get a discussion going. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.